Hi, I'm Esther Hertzfeld, Hospitality Executive Editor at CoStar's, and I'm here at NYU 2026. And I'm here with Jan Freitag of CoStar.
Good morning.
Good morning. Thank you for joining us today.
Pleasure. Thank you.
So CoStar significantly raised the industry RevPAR outlook yesterday on stage. What has given you kind of the confidence to raise all three levers, demand, occupancy, and especially ADR?
Yeah, the first quarter was very strong. I think it caught a lot of people by surprise. Us also to a degree, although my colleague Isaac Kolaza kept saying, something's changing and something's changing. And he was, of course, correct. So we saw a very, very strong first quarter performance. And then that didn't stop. So April was also strong. RevPAR was up 4%. And May, for the first 20 days, was also very, very strong. So we not only saw the first quarter, which was good, but also continued momentum. So we said, okay, if we take that momentum through the end of the year, our forecast has to go up well above 2%. And then we looked at it a little bit more detail. So we're almost at 3. So 2.8% is our official number. Now, that said, that sounds like a pretty big revision from where we were at Alice. But really, we are still the most conservative of the other three forecasters. So maybe there's still even more room to run.
Well, that would be great for the industry. So yesterday on stage, you also downplayed, maybe that's not quite the right word, but the drop in supply growth to 0.4%. So at what point does it's just hard to build, turn into a real supply constraint?
Yeah, so there's occupancy growth for this year because we're proposing that demand growth will outpace supply growth. And that's not that hard because supply growth is only expected to be 0.4%. The long run average is like 1.6. So we're well below that. And when we look at the number of rooms in construction, that number has continued to decelerate. And we're like at, just over 135,000 or so, 140,000 rooms in construction. In 2022 and 2023, it was like 160,000. So that number has come down. And I think the two reasons are it's really expensive to get anything done anywhere. And interest rates continue to be elevated. And we're not making interest rate forecasts, but if you follow, the financial press, it sounds like that rate cuts may be even off the table. And we're now maybe even looking at a rate hike. Again, we're not forecasting that, but money is expensive, building is expensive, and I think that puts a damper on a lot of marginal projects. But now that said, all demand is local, all supply is local. If you look at markets like where we're based in Nashville or Houston, Dallas, Denver, Phoenix, there's still a lot of new supply coming in those southern markets that are seeing a lot of people migrate there. And we see of company relocations there. And so that spurs then demand and then that gets investors excited about building new hotels. But overall for the nation, we're just not seeing a whole lot.
Yeah. So bifurcation is still here, still talked about here. So luxury is still leading, economy is still lagging, but now every segment is expected to show some growth for this year. So what has changed that's allowing that lower end to show growth?
Yeah, that's really, I think, the main takeaway from our forecast revision is that we're now saying for upscale, upper mid-scale, and mid-scale type properties, branded properties, that there is RevPAR growth, which really wasn't the case last year. And that speaks, if you listen to the earnings calls, to the strength of the small and medium-sized businesses, and it speaks to the strength of the leisure traveler. Despite everything that's going on, if you listen to Adam Sachs from Tourism Economics yesterday, he continued to make the case, look, people have a lot of money, they feel richer if they're exposed to the stock market, and lower customer sentiment or higher gas prices don't really seem to matter very much when it comes to people saying, oh, wow, I really want to take that trip. So we're fairly confident that this uptick is sort of widespread and goes throughout all the chain scales. Now, I think the important thing to note here is that we're not proposing huge room rate increases. So for the nation, we're saying 2%. Now, if you think about the rate of inflation, it's 3.5%. So we are still losing, as the economists say, in real terms. We're losing ground. So yes, we're driving our top line, but really the conversation that I'm having here with owners and managers is about the margin, because everything is getting more expensive. And how do you continue to see margin expansion if inflation grows faster than your top line? That's really the big question of NYU 2026.
So there'll be lots of conversations continuing around that. So looking beyond 2026, do you see this bifurcation narrowing, or is the gap between luxury and economy becoming kind of a permanent structural feature?
Yeah, I think luxury can do no wrong. I think luxury is luxury, right? So I present to high-end brands and high-end affiliation companies, and they're the owners that play in that space are saying, look, our customers, they want it when they want it, and they're willing to pay for it. So luxury continues to just go. Very, very healthy room rate growth above the level of inflation, very high. I mean, 4-digit room rates are suddenly normal. Remember when somebody's charged $1,000 and that was sort of noteworthy, and now it's just sort of table stakes at the luxury end. Unfortunately, the economy sector continues to lag behind. And so I'm not sure that that's meaningfully going to re-accelerate. I think it's going to muddle along and there's going to be some growth. We're projecting 0.8% RevPAR growth for economy type properties for the year. So call that flat for all intents and purposes. So where we sit, luxury continues to go up and economy continues to sort of stagnate. And I know that there are, Chris Nassetta from Hilton, for example, talking about this convergence, I'm not 100% sure that we see that in our data, but maybe I should say we don't see it in our data yet. Obviously he's a very smart man and he has a lot of access to a lot of their data and a lot of customer satisfaction, customer sentiment data. And so clearly he's seeing something. We're not quite seeing it yet in our data.
So last night, I've heard you went to a ton of different parties. So you've kind of, were all over the city. So tell me kind of what was the sentiment you were hearing from people at these parties? Like, is there optimism in the air? I kind of feel like there is a little.
Yeah, it was definitely buzzy. It was definitely felt good after last year where things were a lot more subdued, I think. This year, because of the first quarter and, the continued uptick in RevPAR growth, and there's some transactions happening. A lot of refinancing stories, a lot of loans are coming due, and that spurs some owners to say, oh, wow, I can't refinance. I have to put my own equity into it. Let me just sell it. So when I talk to my broker friends and my finance friends, they're like, yep, we are very, very busy. We continue to underwrite deals. So there is a lot of positivity happening. And I mean, the other thing, just personally, I'm a little bit of an older guy, but I go to these cocktail parties and AI has not eliminated the young analyst position. I mean, they were all out and about. So, I mean, that was nice to see.
Well, that was great. So, well, thank you so much for joining us today. I appreciate it.
Yeah, my pleasure. Thanks so much.